Hello, welcome to the fourth episode of Scale by Bangladesh Angels. In this podcast series, we talk to entrepreneurs and investors who have built and invested in businesses that have gone on to raise or generate revenues of millions of dollars, employ hundreds or more employees, and serve millions of users about the secrets of scaling a company. In this episode, we have our guest Akeel Jabber, the investment director at HoriZen Capital, and joining him is our host, Nijor Rahman, the CEO of Bangladesh Angels. Hope you enjoy this episode and make sure to subscribe.
Welcome, everyone. I'm very pleased to introduce the HoriZen Capital team. Akeel Jabber is the investment director and GP at HoriZen Capital, a leading SaaS operations group consisting of marketing and finance experts who specialize in growth marketing and mergers and acquisitions. They're focused on partnering up with handpicked B2B SaaS companies with the aim of helping founders maximize company growth with the help of their data-driven approach. In addition, through the help of their global network of investors and strategic acquirers, they also help companies raise funds or undertake M&A processes. The four core values of HoriZen Capital are integrity, autonomy, commitment, and personal development. And their entire team strives towards living up to these values continuously and seeking partners who share them. Akeel is a growth marketing expert who also specializes in business operations. He started his career as an engineer before entering the world of digital marketing. He then took on the role of CEO at two different digital marketing firms, 99 Social and Increased Visibility Inc. Before joining HoriZen, Akeel was a partner and operations director at Wire Investors, a private equity firm specializing in digital asset acquisitions. Akeel, welcome to Ben. Thank you so much for joining us.
Thank you, Nurture. Look forward to it.
Absolutely. And I know we're joined by Pierre as well from HoriZen. Pierre, welcome as well to you.
Thanks for having us.
Excellent. So, feel free to, tag team and, would love to kind of get both of your perspectives as we kind of go through these questions. So I'll put this to both of you. It's always good to just learn more about where people are coming from and how they got into this space. So where did you guys grow up and what did you aspire to be when you were younger?
Yeah, I can get started. I guess, my parents were first generation immigrants. They moved to Canada before me and my older sister were born. So I was born and raised in, Ottawa, Canada, which was the capital city. We grew up, below the poverty line most of the life, but, made it our way up. And, we moved out to Alberta where I finished up schooling, started my professional career. And that's where I, got into the oil and gas space. And then what I wanted to be growing up, is this as a child, as a little kid, of like what got me excited every morning, or are we talking later on in life?
Maybe even later on. Yeah, whichever one was the most vivid, I guess, in terms of your desire.
I mean, obviously, I think later on I wanted to, get into business. I understand the value, and that got me excited. But I think as a kid, I think I wanted to be like a wrestler. I think that was it. I love The Rock. I still growing up, I look up to him today. For a lot of things, his character, his personality, and even now, he's building his own empire into several brands. So I think that's where my aspirations were.
I remember that because like every Monday, I would watch Monday Night Raw, right? And then, if you smell what The Rock is,
Exactly. I even perfected my eyebrow raise, so I got that
going. That's right. Well, I mean, this will be an audio podcast, so maybe we can't practice that. And what about you, Pierre? Where did you grow up and what did you aspire to be?
Yeah, so basically I grew up in France, as you can tell from the accent as well, in Paris, in the western part of France. And actually fairly quickly, I kind of wanted to be a trader. The reason why is because I thought a trader would be the guy, keeping up with what's happening in the world, looking at geopolitics and trying to figure all things out and be the first one to figure out what's going to be the impact on the stock market. And then when I actually went to business school, I quickly realized that no, traders are not those type of guys anymore. They're more, like mathematicians, guys doing very complicated algorithm. And everything I was trying to get from the idea I had of what a trader is, I realized that I could get it from being a PE investor. Doing private equity and business angel investing and VC investments was quite similar in terms of everything that I was looking for. And on top of that, you actually add that social component where you spend your days talking to very smart entrepreneurs who have a vision and teach you how they grew their company. So after business school, I started in private equity, then moved to PwC, where I worked in transaction services, just to really get better at everything related to financial analysis. And after that, I started as an independent consultant, and that's how we met with Akeel online, and we started working together and growing HoriZen Capital like this.
That's awesome. I love that story because I mean I'm kind of reminded of like, I think the last 3 jobs I've gotten were through online connections, just hitting up people on LinkedIn. So I think it just kind of speaks to the story of or the power of networking, right? And in fact, I think I found Akeel through online as well, and he was kind enough to answer my LinkedIn. So Akeel, thanks a lot for doing that, and this is the genesis of this conversation. No,
Exactly.
thank you for both for kind of that context. I'd love to just learn more about, I guess, then how do we kind of get towards HoriZen? I know Akeel, you have a very interesting kind of perspective here because you're in petroleum engineering, so hard engineering, to suddenly go to digital marketing. And I know you worked with a couple of companies and kind of learned the ropes there. But could you tell us about, I guess, how did that transition come about? What made you kind of pursue that?
Sure. Yeah. So I worked in the white collar industry for several years, and I think I made the full-time leap into entrepreneurship almost 7 or 8 years ago now. But even while I was in universities, I actually launched one of my first actual businesses. It was a recruitment firm where I was hiring tech talent for startups around the world, and that's where I learned and made a lot of the rookie mistakes, like just taking too much time to setting up things like your logo design and incorporating all that. But it did pretty good, but it wasn't something I was too passionate about. My passion was actually always around how to increase my cash returns from the money I was making to replace my income, right? I was in that stage of life where I was like, I need to get out of corporate. I need to replace my income and do something else. But I actually started with investing in the stock market when I think I was 17 years old, and I learned a lot of hard mistakes. But after a little bit of time, I learned quickly after that was a lot of wasn't for me, because you don't have a lot of control over so many factors of when trying to pick the right stocks. A business can be affected by the some news on the other side of the world, and that could plummet your stocks overnight, and there's not much you can do. And then you're also competing with the guys on Wall Street, right? They have a lot more sophisticated tech and experience. This is what they do for a living, and trying to pick better deals than them to invest in, I don't think is that easy, right? That's like playing pickup basketball against LeBron James. I don't think you're going to stand a chance, right? So, and that's when I actually came across a book. I think many of you are familiar with, Cash Flow Quadrant by Robert Kiyosaki. I learned about, generating, investing into cash generating assets, controlling your own income time, and obviously leveraging a bit of debt effectively. So I had some of the cash I used, I saved, invested in some real estate in Canada. I bought my first one, and then I bought my second one. And here I am, about 25 years old. I was like, this is just too slow for me, right? I'm 25. I'm impatient. I want results fast. Like I need results today. But I still like real estate. I still think it's a good investment, but I look at it more of a long-term game. And maybe when I'm kind of a investment, an asset for the long term, maybe for 20 years or so. So then from there, I invested in a physical business. I have a physical franchise gym in Canada. I learned about the recurring revenue model, local marketing, LTV, churn. But same thing, still felt the limitation of that model, right? You're physically dependent in one location. It's super expensive to scale, right? Every time you want to replicate it, you're looking at $500,000 to $1 million. But same, I still look at it about 5 to 10 year return. So still pretty good, but I need it faster and faster. And that's when I learned about digital and online businesses. I actually bought my first online business from a brokerage called Empire Flippers. It was an affiliate site at the time. I think I paid less than $50,000, and I was hooked. And that's where I learned all about the online marketing, conversion rate optimization, SEO, hiring writers, affiliate marketing, all that good stuff. And that's around when I quit my job then. And a year or so later, I joined a firm called Wired Investors. They were essentially doing the same thing, right? They were building a portfolio, but they were just doing it at a larger scale, right? They're doing bigger 7-figure acquisitions, and helped raise some capital, get involved in some of the deals, and then they were looking at a deal at the time called $99 Social, and put my hat and name into the hat for being CEO. And within 5 months of when I took over and was managing it, was able to double the earnings of the company. And that's when over time took over another company, and they asked me to move to become a group CEO of the SaaS portfolio. And then about 2 years ago, that's when I left the group, and I decided to focus on launching HoriZen Capital. And that's where we really focus on SaaS companies as our expertise, and that's where I enjoy most of my time today.
Yeah, I mean, this is I mean, this is quite fascinating that you could kind of go and just find an online business like you would on Amazon, like you would, pick out shoes or something, and just, hey, I'm going to run this, and you can do it, and that's the beauty of, I think, the world that we live in. And I think, we'll discuss more about how we might kind of replicate this model for Bangladesh later on in the conversation. But definitely, Akeel and Pierre, let's kind of deeper dive into the model of HoriZen Capital, and this is a great segue for it. So, and feel free to alternate, whatever is easiest. But curious, so, just first the business model, right? So what I understand is, you guys do a few things. So one is kind of training, another is kind of consulting and M&A kind of investment advisory, which then in turn funds acquisitions of these types of, online digital SaaS businesses that you're talking about. Is that the business model in a nutshell?
Yeah, I mean, our core model is, that's what we start with. We partner with B2B SaaS companies. Essentially what they're doing is looking to accelerate growth. And that's one way or the other. Whether that's through capital, not only with capital, but with a partner who understands operations, marketing, how to scale. And then also, if needed, we'll connect them with our network, which could be, other founders, other portfolio companies, investors. So we're kind of like that suite. So, from the whole kind of spectrum of, how to grow a SaaS. Maybe Pierre, if you have anything else you want to add to that.
Yeah, that's kind of the idea. The idea is to take the in-house skills that we have in HoriZen, and the core skill we have is private equity investing, it's financial due diligence, it's digital growth operation, it's M&A, plus a network that we can tap into. So the whole idea is to kind of have a mix of entrepreneurial spirit, where we grow our own company within HoriZen Capital, but also consultancy, where we help other company grow, and equity partnership, where we want to be long-term partner and provide those skills that we have in-house to those companies who are either struggling or don't necessarily know what the next step is going to be, where we can come in, and be there to help them first grow, increase their value, help them raise capital, and help them exit as well.
Excellent. And totally see where the skill sets kind of come into focus. I know you have a syndicate, and I think we understand what a syndicate is, but from your perspective, what does it mean to be a member of your syndicate or operators group, and what are the requirements to be one, and what are the requirements of membership?
So the investment club, right? So with that, I mean, it's value just, capital is one thing. I mean, we do have a minimum check size of 100K. That's kind of the one thing, but the value beyond that is beyond the capital, right? That could be operational, that could be the network you have, or any kind of business background to basically contribute to the decision making of the businesses that we acquire. But at the end of the day, what we really want to see is that the engagement and feedback when we bring deals to the table. So we like to talk to all of our investors, get to know them, right fit, and they can be value adds to the portfolio beyond just the capital.
Got it. Then on the sort of acquisition process and the screening, first, what kind of companies are you looking for? Having looked a little bit at your portfolio, there seems to be a slight overweight towards kind of marketing and sales software, but curious, what the thesis is when it comes to the sector.
Yeah, I mean, that just happened kind of naturally. It seems like what we seem to attract. And actually, we're working on another business. We're going to start, I think, in November. I think one or two, and we have in the pipeline, and both are also in marketing tech. B2B SaaS, generally the founders who are usually coming to us have a strong product background, a really great SaaS solution, and they've grown organically or just through one channel, and they really haven't done much for marketing. That's generally the companies, boot or VC back, doesn't matter. 1 to 5 million in ARR range, profitable, or at least cash break even. We don't look for companies that are burning, VC kind of backed businesses. Monthly less than 3%, at least 3 years of revenue, and growth, at least I think 10% is the minimum, but we're generally looking at 20-30%.
Yeah, and to add on that, there's also, since we're also looking at companies outside of the US and North America, a good type of company is basically who've managed to grow to their limited country We've looked at companies in Poland, for instance, and looking to go outside of their national monopolistic markets and want to grow. And obviously, the North America or Europe is the next target for them. And since those are markets that we know, we are generally well positioned to be the partners to handle that side of their market and that side of their growth.
Interesting. So that's another value addition is, I think, market expansion, as you're talking about, and particularly kind of playing the arbitrage game between these markets. Wanted to just hone in on that a little bit, right? So the 1 to 5 million ARR range. Do you work with typically earlier stage companies? So these sound like companies that are relatively mature, at least in the current iteration of the business model. Just curious how that number came about as sort of the sweet spot.
So on the acquisition side, that's kind of our range that we look at. 1 to 5 is kind of what we found a sweet spot where there's still product, close to product market fit and less risk and return for our investors, and we feel we can make the most impact. On the other side of our business model, where we focus on the partnership, we generally do work with earlier stage startups. At least let's say at least 200K in ARR, so a little bit smaller. They've built a good product, and same thing, they just haven't been able to prove anything on the marketing side.
Makes sense. Another criteria being the monthly churn rate, and I think it was around 3%. That's sort of a threshold or kind of a guiding factor. It seemed, as a non-SaaS person, that seems like very hard to achieve. 3% churn like that, and just curious. Does that mean mostly enterprise here? Does that mean what kind of companies does that entail then if they have such low churn?
I think we're not seeing that, right? We're seeing like for SMB and mid market, right? There isn't much enterprise, a lot lower here.
So actually, when you think about it, try to think about it annually. Like if you take a 5% churn rate and that converts into a 60% churn rate, monthly, they convert to 60% annually. So that means that the company has lost more than half of their customers within 1 year. So at first, we started with that threshold at 5%, and we quickly realized that some of companies that fall within that 5 were still losing too many customers, and we saw a high risk with that. So that basically means roughly that you have to renew around 35% of your customer, which is still a high number for me, but at least is more manageable. And basically on the SaaS market, it's quite common to have companies that have less than 1% churn per month. So like the most successful one, and those are generally the VC-backed one, right, and become unicorn, have negative churn because they onboard customer, and the longest the customer stay, the more revenue they manage to have actually.
Which makes sense. So you're looking for a certain level of, I guess, stability when it comes to the customer base, and they prove that kind of out over time, and hence the 3% monthly or 36% kind of annual churn. Another question on these kinds of acquisitions, in these cases, I'm sure it's different for each company, but are the CEOs of the founding teams typically looking to actively sell? Are they looking to get out of the business, or they're more looking for like a long-term partner? What's kind of the profile of the CEOs that you want to work with?
I think we have both, right? Like we have the ones coming to us, like we have a lot of inbound, lead flow, people coming to saying, hey, like we're looking to sell, we're at the stage, we want to know what our valuation is, and what can you expect? And then we also have a team, reaching out, Pierre manages that and probably can speak a little bit, but we're going to people and saying, hey, like we've done a little bit of research, we know you're probably at the stage of the size of what we're looking for. You've been in business for a while, and we're like, hey, like, do you want to have that conversation? And I think most people, if approaches you and say, hey, do you want to sell your business? They're at least interested, right? They want to hear what they're going to get. They probably have a number in mind, and generally that's where maybe the conversation falls apart because, they're a later stage of what they're expecting. But if they're too early, right? Like they're in growth mode, like they're super focused and they're like, look, I don't want to give this any time right now. Let's chat again in a year or two. But I don't know, is there more you're seeing there, Pierre?
Yeah. So it really all depends on the psychology of the founder. Generally, if they are first-time founder and they've been growing their company for, say, 7 years, they feel like that if they can cash out and get a few million out of the deal, they're going to be set financially for life. So they are more interested to sell at this stage. If you start talking to a multi-founder, we see more people saying, look, guys, we're happy to have a partner. However, we're not going to sell 100%, or we're going to do it at a very high valuation, right? Which we wouldn't be able to match. But overall, every conversation is different, and we're just trying to make the most out of it. The only thing I would add is when someone comes to us and say, "Oh, I want to exit the business," we're generally super extra careful to make sure that they are not just trying to do sales with the right timing, where we take over the business and 6 months later we realize that the business is just declining.
Right, a surprise, right? You don't want those negative
Yeah.
surprises in the business, once you come in. And then on the structure of the deals themselves, once again, I'm sure it's it varies from deal to deal. But the first question that comes to mind is how come let's say even if the management team stays intact or stays to an extent, how come you're looking to take majority stakes on these companies?
So we actually started with that model, right? And that's when we started kind of going out to market, we're saying, let's take over. That's kind of what we're familiar with, like, at least 51% where we have some kind of control. The founder can move. They don't want to be operational. And we just kind of take over the business. But then that's when we kind of move towards that growth, equity and partnership model, because we found a lot of the conversations I think Pierre we're with was like, look, we're not ready to sell, but we do want to, we'll work with you. We do see the value that you bring, but we still have, a lot of room to grow. And if you can work with us, let's get there first, then maybe we can sell it together. So I think that's why we made that shift.
Makes sense. On the I guess the structure on the syndicate side itself. So you pull together these investments from your syndicate. Do you put these into an SPV, and for that SPV, do you guys take a management fee? What's the business model there when you deal with the investors?
Yeah, it's an SPV, so we'll set up a separate entity. We may come in for ourselves for maybe up to 10% of the deal. Our fees are generally rolled into the deal kind of for the first transaction, and then our management fee, then like the VC or PE model, because we're actually very hands-on. We're not just putting money in and kind of letting. And then a lot of it is based on the upside performance and the growth. So as the company grows, we get percentages in growth based of the business.
Right. So that's separate from a carry, right? That's not until you exit. So you are taking, I guess, a management fee based on, I guess, incremental sales growth and things like that. Is that correct?
Yeah, that's correct.
Got it. With regards to, which makes sense. And then another question, so it does, is there a possibility of leverage here when you take over these companies, because these are cash flow generating businesses, they're profitable? Is there a way to kind of, spike your returns or increase your returns by way of debt into these structures?
Yeah, absolutely. We have a quasi equity partner and based out of Canada, and we work with who I think they've designed their actually debt program specifically for SaaS companies. So where a lot of the principal is delayed, and the interest, the interest, and most of the payments and returns they're made are 3-4 years in or at exit. So we definitely look at leveraging them if possible. But I think generally based on the numbers we run, Pierre, I don't like putting in actual debt. I think it doesn't usually work for our model.
It depends. It really depends. Like if you end up with a very highly cash flow generative business, like we've seen a couple, then obviously you can increase the leverage, right? And at the end of the day, it's also all based on the multiple of EBITDA that you want to put up on the company. What's going to be your growth strategy? Because generally with SaaS businesses, when you invest in front, and through the fact that people are recurring revenue, you get the revenue over the long term, right? But that does mean that you're going to have a through in cash that you need to plan with if you want to put debt on the company, on the deal.
That's a great question as well. Do you have a sort of a target range in terms of a multiple on EBITDA that you apply? Is it price to sales? Is it DCF? How do you value these companies?
I'm going to share an article actually in the chat group with you, how we value SaaS businesses, but maybe Pierre, we base it up basically off of ARR or stationary earnings, but maybe Pierre is the expert in that.
Yeah. So the reality when it comes to each company, opinion, there may be a different. You can do a DCF, sure, but you have so many variables and so many potential variations in your future cash flow that the DCF doesn't necessarily make sense. It's more like a double check your valuation, right? So what we're trying to do is more have a high level valuation based on comparable what the market is telling us and what the market does. And for those type of company growing at less than 30 to 40% year on year, we're just generally trying to target between 2 to 4 times ARR. And we double check with EBITDA as well. And that's generally going to fall within, say, 4 to 8 times EBITDA, right? And the reality is we know that there are deals made higher valuation than that. We're trying not to play this game because the view we have is at the moment, there is a lot of cash on the market. There's a lot of deals happening and prices are driving up, are definitely going up. So we have to follow that trend, obviously, and the price increase when you buy, but they also increase when you sell. So in the end, you still can kind of make money at the end. However, we're really trying to be very strict on not overpaying. And that's the advantage of our model. Since we don't have like a fund that we have to invest within the next 6 months, we can make sure that when we do a deal, we do it at a price that we think falls within a reasonable amount.
Right.
In valuation.
Because that deal by deal structure kind of gives you that flexibility of waiting for the right deal to come along. But then obviously when you have to do it, you got to move very fast and you have to have the infrastructure in place concurrently as well. Quite interesting on the other side, like, so that's quite an interesting framework. I guess the other side is, how long do you intend to hold your stakes? And second, what makes sense as a reasonable kind of return expectation for you guys? Because these are not startup businesses, right? And you're not coming in at the angel stage, for example, but they're not exactly, they're kind of maturing, but not necessarily. So curious, what kind of returns make sense?
So generally, the first year we're reinvesting most of the cash flow back into the business, into growth, and really driving it up. And then we think at least the 36 to 48 month plan makes sense. So now we have 2 or 3 years of really driving up performance. So that's kind of our plan, is 3 to 4 years to exit. I think that at the low end we're looking at least 30%. That's kind of on the minimum of making this viable for investors and for the risk they're taking. But we target at least 60% plus is what we kind of expect.
Got it. And who are typically, who would you exit out to? What are some platforms or acquirers that would make sense for you?
So I mean, we're getting, like I said, we're getting a lot of interest. Let's say, like we're saying, the marketing tech space. I think there's a scenario of maybe selling as a roll-up strategy to a bigger PE firm. But we also have a large network of some strategic buyers, and that's kind of our biggest reason for building our M&A practice, was actually building those relationships with all these strategics and corporate development space. So we know what they're looking for, we know what the size, what the type of business is, and now we have that conversation, that relationship with them, and when there's a time to exit, we can reach out and start that conversation.
Yeah. And we also have a good relationship with founders very active on many markets, like Micro Acquire, that you may have heard of. They're developing a new platform, digital to sell SaaS businesses. And for the moment, they target small deals, but given how fast they're going and the fact that they raised a decent amount of money recently, I feel like within the next 3 to 4 years, I wouldn't be surprised if deals over 5-10 million start to happen on the platform.
Quite interesting, and I think I think we probably need to look into Micro Acquire a little bit more. No, thank you so much to both of you for that. I think we're much clearer on the model and the approach of the investment piece. I'm now curious on the actual playbook, right? As you kind of go in and you create kind of value within the companies that you work with. And so first, what sort of, I guess, OKRs do you establish when you come into a business? Like, what sort of metrics are you trying to kind of engage as the North Stars to improve the company?
So I think growth is one thing, but we look at it. Every business is unique, so I can't say there's one specific one. If there's a playbook that we're applying, generally we like to front load conversion rate optimization. I think that's the kind of quickest win. If you apply, you can see some quick returns on the business. And here's maybe just a quick tactical tip here for people listening in. I think the quickest thing you can do is actually test your headline. If you haven't done it for your SaaS and you're getting fake, like just test it out, test different copy there. 80% of your users stay there, and that's when they first arrive at their site, and they're going to make most of their decision there. So, I would suggest maybe doing that if people are listening. In terms of OKRs, like, we're setting 1 to 2 per quarter. If at the time, let's say we're focusing on conversion rate optimization, then we're going to write, okay, we want to increase conversions by X% to this percentage. Okay, let's say by 30%. So these are some tests we want to run. These are some experiments, who's going to do what, and these are a weekly kind of check-ins. If we're top of the funnel focused, okay, like let's say we want to focus on SEO, let's drive some links back to the site, drive the authority up. Okay, so now we have to do guest podcasts, we have guest articles, and let's start building backlinks. And how many do we need to get, and just kind of reverse engineer that back and kind of build from there.
Got it. I know we had our mutual friend TK on the call a few months back, and he was just kind of saying, obviously it's not too simplistic. It can't be too simplified, but one tactic that founders don't use often is just raising prices, just raising prices and trying to kind of maybe renegotiate contracts. I mean, is that something you also look at, is whether or not you could raise prices or renegotiate some of these existing contracts in the businesses?
So we're negotiating sales contracts. I don't think we've done much, but I mean, if they're coming up for renewal, I think it's a good time to have that conversation. But 100% pricing is a super easy kind of uplift of testing out different pricing and seeing how that impacts conversions. I think that's part of our initial testing we do. And yeah, raising prices is an easy one.
Yeah, and on top of that, with companies that are like sub 1 million or within that range, it's actually quite common to see them with non-sophisticated pricing strategy, where they have, for instance, one plan. So one of the first things you do in that case, you introduce 2 new plans, right? And 90% of the case, you generally have immediate positive results from that.
That's quite interesting. Another one, so going back to, I guess, conversion rate optimization, but at the top of the funnel, what sort of things do you help these companies do when it comes to, I guess, increasing more people or more prospects at the top of the funnel? And curious, what are some things you can help them do?
So top of the funnel, right, is more just driving more traffic to the website. So that's what through SEO, so paid channels, through integration or other channel partners. Or through cross marketing with different affiliate partners as well. And then from there is okay, we have a bunch of traffic coming to the site. Now, how do we maximize the value of each page view? We break it down by user, by lead that comes in. So that's a freemium model. Then okay, every lead that comes in, how do we now convert that? So that's focusing on our onboarding. Let's focus on the email marketing. So we look at the entire kind of the funnel, and then we kind of look at areas of optimization across each side of it. So whether, like I said, like onboarding from the sales call to the demo, setting up metrics around that on how we can improve it.
Another one that I found interesting is just kind of monetizing email lists. And I know you help the companies do that. Could you tell us what are some ways to do that as well?
So I think this is something that people just leave. They might set up like an auto email marketing platform. People subscribe, and then they have 5 or 6 emails going out, and they don't really segment it out. So I think good segmentation is probably the first thing of filtering and qualifying different customers, and then from there, focusing on the middle of the funnel is like really engaging them to get them back onto some kind of conversation, because most people sign up for a SaaS and they might use it a little bit and they might may forget about it. And the best way is just keep re-engaging them, having a weekly monthly update with them, and getting them back in to remind them of why your tool's changing, what's the updates happening, and get them to re-engage with your tool. And that's going to end eventually drive LTV up and revenue.
Another thing that you do is kind of work on kind of lead generation and outreach campaigns. What are some core elements of such campaigns, and what are your preferred kind of platforms to be able to do that?
So the 2 main ones are going to be email and LinkedIn. I think we even do this in-house for ourselves, which Pierre manages. But maybe Pierre, you want to speak a little about that?
Yeah, and that will also comes back to the question that we had from Navojit on how we maintain a good deal flow. So basically, on top of like the inbound deal flow that we get from our presence, online presence, and from participating into the online events, also writing articles, etc., etc. We also have a network of M&A advisors who send us deals, and we have all the part of the outreach. So to do that, we managed to find database of SaaS companies that then we check if we think they fall within the size of the company that we want to reach out to. And based on experience, we usually use the number of employees as the best proxy, because you have a lot of sources out there that tells you how much revenue companies are generating. From my experience, most of them are actually wrong, and sometimes are really, really wrong. Like I've reached out to companies that were listed as doing 5 million in revenue, and they were doing only 10K a month. So the way then we structure the outreach, we use tools like WeConnect, for instance, on LinkedIn, that help with automating the outreach. We also use other automated tools for email, like Apollo. That's pretty efficient as well, also to get the data of the people. However, I think that's important for line of business. We do a lot of work before actually using those automated tools, as emailing. Every person that we email, we've actually at least went on their LinkedIn profile. We check that the company fits our criteria from what we can see, and that the website looks good, and out to targeted people, right? And sometimes we also try to add a bit of personalization to the email or to the message by looking up articles they wrote or events they attended, so that we can actually have a one-liner which is specifically dedicated to them. And based on that, we way higher conversion and response rates. Like typically for a LinkedIn campaign, to 100 people you reach out to, 40% actually accept the invite, 20% respond, and 10% agree on a call, roughly.
Another one, and thank you for that. Another one I saw that you guys do is, a big part, and you mentioned kind of changing the headline, but redesigning websites, right, with better call to action or better integration of chatbots and things like that. Could you I mean, is that expertise you have in-house, or do you work with the existing kind of web team of the company?
So it's something we have in-house. So we have a conversion rate optimization team we work closely with, and designers design. I mean, we just have some kind of frameworks that we've seen that convert better on your landing, or even, within, if you have some couple of blog articles that are, you're ranking well, you're getting a lot of traffic, generally audit, you'll see, okay, these are the top 10 pages getting most of the traffic. Let's see what we could do, whether they're putting different engagement and call to actions throughout it to try to drive more leads. But yeah, that's kind of how we work.
Got it. So those are on the conversion rate or conversion side, more revenue generation, LTV, and those kinds of things. What about helping them save costs? So definitely trying to lower the cost of acquisition, but what are other ways in which you help them kind of optimize the cost structure?
So operations is obviously the one thing we'll look at. If we have some kind of redundancy and overlap within our team, which we might be able to reduce some OpEx there. Outsourcing is one thing. I mean, generally, we don't like to make too many changes up front, but if there's something there, we'll explore it. And then cost of acquisition. Yeah, I mean that's a big thing we look at. Once we're even sometimes before we do additional investment, we'll run some experiments. We'll run a full audit, and we have some specialists who can really scale. Focus on SaaS company. If we're running a $2 million per month ad budget, there's no issue. We can manage that as well. So.
Quite interesting. I'll just kind of, maybe we can talk about a couple of, I guess, case studies now, and maybe we can kind of contextualize some of the discussion we had. So one is Postalytics, right? So you helped you improve the conversion rate by 25% in 4 months, which is quite remarkable. Once again, for those in the room, could you explain what the company does, what the engagement was about, and what are some levers you pulled to be able to achieve that?
So Postalytics, and most of you are familiar with direct mail, right? If you want to print a postcard or something in the mail, you want to send it, you would go out to a print shop and hand them your design, and it was very inefficient of how it was run. With this, they built a platform, a suite online. You go in, you build your design template online, just like an email marketing, like a MailChimp. They have a network of partners throughout the US. And I think now we're expanding to Canada, I think next month. And it's simply done. I mean, it goes to a print network, we can design it, and we go out to, you can send it out to, you just upload a list and you can send that out, no issue. In terms of what the engagement with them, we had the partnership model. So they were not ready to sell. They want us to, they keep growing. And so we decided to work with them. Let's focus on conversion rate optimization. And then we went to start working on different channels. And, here's the case study here of how we did it. The way our kind of partnership models work is we reduce our cash fees. So we aligned our comp structure so that we actually reinvest most of our fees back into the company. And then we look to raise a growth equity round in the near future, and then eventually exit once we hit, I think, close to 10 million is the goal with this one.
Excellent. Another one, this one's from outside North America. So this one's Green Digital in Brazil. And, read that, you helped increase the lifetime value of each franchisee by 3x, which once again seems quite remarkable. So could you explain what Green Digital does and the business model and how you help them?
So they're a franchisor. So I think it's called, what's that? Digital marketers. And I think they're based out of the US. So similar model where, they help people set up a firm, in Brazil. We actually ran a few experiments with them before the acquisition, mainly on the pay channels. And all we did is, we made some switches on the audiences. So we actually pulled their list, ran some lookalike audiences, tested some different ads, and we reduced we saw CPA reduction by more than 70%. So that was, got quite interesting, caught our interest there. And the second thing we did was, as you said, increase our pricing. What we found was we were actually drastically underpriced in the market. I think it was, the average price of all the competition was something around $25,000, and we were charging $5 or $10. So just people, it sounds good, right? Hey, we're the cheapest guys out there, but it actually scared people away. We were feeling, people were like, no, this is too cheap. There must be not good. And that perception is everything, right? The value. If you're too cheap, sometimes it actually detracts a lot of the people who want to work with you. And second thing we found and added to that was adding recurring fees. So these were generally, 2-year, engagements or contracts that people would come in. They pay the one-time fee, and they'd be engaged for 1 or 2 months, 3 months. Even though we're there, we give them support. But at the end of the day, they have to do the work. But they would drop off. You keep bothering them, yeah, I'm busy. They get caught up, and so what we found is by just adding those fees, where now they're like, okay, I've got some pressure here. And I think this came from looking at some of the real estate models out there, right? If you want to become a realtor, you see people who are paying those high fees. Those are the ones who are performing a little better. You're going to get that engagement, right? And that's what we found is they had a lot more commitment to the work, and they reduced the drop off. They got better results, and overall that increased the LTV.
Quite interesting, and kind of staying with that theme of what are some international opportunities, and one opportunity I'd love to discuss with you guys more in depth and going forward in the future. And I've had a few kind of initial conversations with some of our members as well, particularly in the outsourcing industry in Bangladesh. And the idea would be whether it's, let's say an accounting company or, a graphics editing company taking over, these smaller SMBs in markets like Europe or North America, and then outsourcing elements like lead gen or back office operations or content to a low cost locale like Bangladesh. And using that as part of so potentially taking over these companies through a search fund or an SPV model, and then doing, reducing costs, and then over time maybe selling them off. But yeah, just curious, has that been something you guys have pursued before? Maybe say in the Philippines or in India, is that a potential model that could work for maybe the space that you're working in?
We work with people all over the world. Our team is international, from Brazil to Mexico to Philippines, India. No issue. We work with wherever. I know right now we are hiring an intern, a business development for our own in-house team. Maybe Pierre, if you want to chat, maybe we can just throw it out there if anybody's looking for something to join HoriZen.
Yeah, so trying to find the right people with the right entrepreneur mindset to help us and focus on finding deals for us, and also growing some of the businesses that we have, like the financial due diligence course that we have, for instance. So we're kind of looking for someone who's fairly autonomous, has a real drive, and will do a bit of marketing and pure business development / sales type of guy. But going back to the geography, yeah, we actually see a lot of interest from India. Well, we have a lot of conversation with Indian companies. We have a few clients that are Indian actually also, and their all view is in that region of the world, Sri Lanka, Bangladesh, India, there are amazing entrepreneurs, really good developers, and they're still operating on the market, which is growing fast but not mature, and they have huge potential to boom on the US market. But and generally, that's also where we're trying to position ourselves as the long-term partner who will be able to help them, move from their local market to the US market and to the European market.
Right. So that's the opportunity, I think, for such firms. And the other could be that, maybe these companies are already serving those markets, but from their base in, say, India or Bangladesh, and maybe infusing some of the things that you guys are doing when it comes to, say, digital marketing, conversion rate optimization, et cetera, as well, for them to acquire more customers. No, it totally makes sense. Thank you to Pierre and Akeel for joining Bangladesh Angels. We look forward to more conversations in the future.
Yeah, but thanks a lot for having us.
Thank you so much.